Welcome back to Out of the Rough. I'm Fred Arnold. I'm here with Dan Kravitz. Dan Kravitz is the president of Kravitz Incorporated and co-author of Beyond the 401k and an expert when it comes to businesses creating a retirement plan for the future. Now, you mentioned that one of the 5 mistakes that business owners make is that it's too expensive to set up a qualified business or a qualified retirement plan. Mm-hmm. Tell me more about the qualified retirement plan.
You know, Fred, there's lots of different types of qualified retirement plans, and the most popular being the 401k plan. And like I shared during the first segment, 401ks is a great vehicle for most workers, but there's a lot of other alternatives. There's things like simple plans and SEPs and ESOPs and defined benefit plans. The one alternative that stands out for small business owners that we're seeing a lot of energy recently is around a plan called a cash balance pension plan. Those have become increasingly popular and are growing rapidly right now.
Tell me more about the cash balance pension
Sure.
plan. What makes it different?
Yeah, the big difference between a cash balance plan and a 401k plan revolves around the limits. Like I shared earlier, the most you can put into a 401k plan is $16,000 a year if you're under 50, $22,000 if you're over 50. Like we talked about earlier, a lot of small business owners need to catch up. They need to squeeze 20 years of savings into 10. And like you suggested, those limits will not let you get there. Cash balance plans are not subject to those limits. The older you are, the more you can put in. And just to give you an idea, a business owner in his or her 50s could put in up to $200,000 a year into a cash balance plan. You and I are in our 40s. We could put in up to $125,000. It's age-weighted. The older you are, the more you can put in. But you can see if you're a small business owner and you need to catch up, and if you're looking for a large tax deduction, 401k will not meet your needs. So that's why we've seen a propensity of small business owners to install cash balance plans to meet both their retirement needs, to catch up, and their tax reducing needs, to reduce their tax hit.
No, I think that's absolutely critical that you mentioned that is the catch up on it, because a lot of business owners, like we talked in the last break, are piling their profits into their company and into their employees. Yeah. And I think that's great, and I think they should. Mm-hmm. And you own a business, I own a business in the mortgage industry, and of course you're in your industry as a consultant. It's absolutely critical that we make sure we save enough for our nest egg, just in case.
Absolutely, Fred. I know, and I work with a lot of small business owners, and like we talked about earlier, they don't really take the time to create that nest egg. They're so focused on their business, and so am I. You know, I definitely spend 99% of my time trying to figure out a way to make sure that Kravitz does a good job in terms of setting up and designing qualified retirement plans. But like I shared earlier, one of the big mistakes most business owners make is they don't take the time to understand all the different alternatives with regards to qualified retirement plans, and then set something up that meets the needs of their employees, which is critical, but also can be used as a tool to, again, those 2 big pain points: the fact that they have not saved for retirement, so we've got to catch up, and the second really big pain point is this huge tax hit. A profitable professional company like a small business, you know, it's difficult to watch all that profit go back to the government in taxes. Yes. So if we can figure out a way to help that business owner shelter that from taxes and put it into a qualified plan, and a cash balance plan is the ultimate vehicle for that, because the limits are so high.
Right, and I'm a big believer, a small business or business in general in this country, that those are the entrepreneurs are the ones creating jobs. They're the ones that you want to have confidence. Mm-hmm. I want a business owner that's 50 years old to have caught up, to have a good amount in their savings account, because what are they going to do in their latter years? They're going to help invest in their people. They're going to invest in their company and ultimately invest in this country, which is absolutely critical. But if they're always playing catch up, if they're always worried about that and they don't have a vehicle to do it, then they can't do that. And yeah. I'm sure you see that all the time.
Yeah, absolutely, Fred. So definitely what we've seen, and there's, like I said, there's lots of different types of qualified plans, and a good way to think about this as a small business owner. A 401k plan is a great place to start. You definitely should have a plan like that in place. It's a great attraction tool, retention tool for my employees. But if things are going according to plan and there's a profit at year end, a second plan should be established, the cash balance plan. And a good way to look at it is the 401k 401k is primarily for my employees. The cash balance plans is for myself or maybe my partners. And that's a way for us to make sure that we take some of that profit and set it aside in something other than our business.
Now, can you have both? Can you have a 401k for your employees and a cash balance plan for yourself?
Absolutely. You can definitely have both. In fact, we don't typically design a cash balance plan without first making sure there's a 401k plan in place. And the reason why, there's some complicated IRS testing that has to be done to prove non-discrimination. So we'll oftentimes see when we design a plan for a small business owner, you'll see a contribution from the business owner going in for his or her employees into the 401k profit sharing plan. But then you'll see a large contribution for the owner and a very small contribution, if any, for the employees in the cash balance plan. And then we test those plans together.
So the employees really benefit too.
Oh, it's a huge benefit to the employees. What oftentimes what we see is, let's take a small business owner and they have $100,000 of profit at year end. We can typically design a plan where 90% of that money will go into an account for the small business owner and 10% of the money might go into the accounts of his or her employees. The employees look at this as a great opportunity for their retirement savings.
And a little bit of a windfall.
A nice windfall. And truthfully, what we tell small business owners is Uncle Sam is paying for that retirement benefit for you and your employees. If we took that $100,000 and paid it to ourselves as income, we would only get about 55% of that money. 45% would go to taxes. I'd much rather give my employees a few $1,000s than give Uncle Sam $50,000 in our example.
And that's huge, because not only are you going to pay taxes in many corporations or many companies, corporate tax, but then you're going to turn around and you're going to pay personal tax when you can actually distribute it to the employees and yourself, and everybody wins. I love the concept. We're going to jump to a quick break and continue to talk with Dan Kravitz, and again, co-author of Beyond the 401k, about how you can get out of the rough into success and make sure you ensure your financial future.